we think we're now close to the peak.
Dubai's property market is booming once again. 2024 saw record-breaking activity. Total residential sales hit 171,000 units, over 5 times the volume of 2020, and off-plan properties dominated this surge. Off-plan transactions now account for roughly 60 to 63% of all home sales in Dubai, a clear jump from 54% the year before. This reflects a shift in investor preferences towards new developments, fueled by attractive payment plans, developer stock, pricing, and a tight supply of quality-ready homes. In this deep dive, we'll boldly analyze the off-plan frenzy versus the secondary market and distressed sales as well. We'll put in hard data, charts, and unbiased look at major developers like Emaar, Nakheel, Meraas, and Aldar, highlighting not just the hype and opportunities, but also the risks and downsides. Let's explore where the real estate momentum is coming from and what it means for the investors in 2025 and beyond. In this video, I'm breaking down exactly what the next 5 years from 2025 all the way till 2030 could look like for Dubai's property market. Here is what I'll cover in this video. First, Dubai economic and population growth. Second, the supply wave. Third, price forecasts and potential corrections. Fourth, which developers and projects are likely to outperform. Fifth, the biggest risk investor must prepare for. Dubai's off-plan market, selling properties before they are even built, is on fire. As noted, nearly 2/3 of all sales in 2024 were off-plan units. Why this rush to buy unbuilt home? For one, developers offers incentives, prices that seem competitive, at least versus future value, flexible payment plans, and the allure of brand new units with modern amenities. In a booming market with limited high-quality ready supply, many buyers, both investors and end users, are choosing off-plan to lock in a property now and pay gradually. The result: 428 new projects launched in 2024 alone, with major developers scrambling to meet demand. Emaar Properties, Dubai's largest developer, led the charge with 44 project launches and 16,666 off-plan transactions in 2024, delivering over 18,000 new units itself. Overall, more than 102,000 off-plan deals were recorded in 2024 out of 169,000 total property sales, a massive flow of investments into under construction real estate or off-plan properties. Yet, beneath the frenzy lies a paradox. Buyers are often paying a premium for these unbuilt properties. Market data shows that off-plan properties in 2023 sold for 25 to 50% higher price per square feet on average than comparable ready or secondary properties. In theory, buying off-plan should be cheaper since the buyer bears construction time risk and essentially funds the developer. But in today's Dubai, the opposite is happening. Demand is so high that developers price new launches at a premium. Developers justify these prices by offering superior quality and amenities in new projects or developments, smart layouts, latest facilities, prime location. Moreover, off-plan stats include all units, good and bad, in a project, whereas in the resale market, often only less desirable units trade. Investors hold the best units, making secondary averages look lower. Aggressive marketing and broker incentives also drive off-plan craze or the property's transaction. Sales agents heavily push new launches. Developers pay higher commission than resale sellers, creating buzz among buyers. Does it actually pay off? Often yes, but not always. A data analysis by an independent consultancy found that at least 60% of off-plan buyers saw their property's value at completion either equal or lower than what they actually paid. In other words, a majority of off-plan investors from past years broke even or lost 10 to 20% by handover time. Only around 40% managed to gains, typically those who picked exceptional projects and locations. This happens because once the shiny new home becomes secondary secondary. If the initial price was inflated, the resale market might not support it immediately. The current off-plan boom echoes past cycle. During the mid-2010s, developers flooded the market with projects. By 2018, an oversupply led off-plan sales to slump. Off-plan shares of transaction fell from 67% in 2017 to just 58% in 2018, and prices dropped in many communities. Dubai's last downturn, 2015 to 2020, saw prices slide roughly on 30%, with an outright crash of 53% from 2008 to 11. Off-plan buyers who bought at peak in 2014 often had to wait years for values to recover. A strong end-user demand, people moving to Dubai to live, is absorbing new inventory, alleviating oversupply fears for now. Government policies like investor visa and zero income tax are drawing more long-term buyers. And with Dubai's population surging from just 1.86 million in 2010 to roughly around 4 million in 2025, a 110% jump. The city plans for 5.8 to 8 million population by 2040, meaning 300,000 new homes needed by 2029 and possibly 70,000 units annually through 2040 to meet housing demand. These fundamentals suggest continued appetite for off-plan developments, but investors must choose wisely, distinguishing high from value. The secondary market refers to completed or ready-to-move properties. These ready homes have their own appeal. What you see is what you get, and you can move in or rent out immediately. In Dubai's current boom, secondary sales have also grown, up roughly around 11% year-on-year in early 2024, though not as expensively as off-plan. Many buyers, especially end users, still prefer a finished property that they can use now, rather than waiting 2-3 years for an off-plan handover. Secondary market buyers also avoid construction risk, delays, changes, or project cancellations, and often negotiate better value per price square feet. In fact, some investors on the ground note that off-plan used to come at a steep discount. Now it's often more expensive than secondary, with none of the benefits. This dynamics has made savvy investors reconsider the resale market, where you might find bargains or at least fairer pricing. Another advantage of secondary properties: immediate rental income. Dubai's rental yield are among world's best, averaging around 5 to 7% gross in many areas. If you buy a ready apartment, you can start earning rent right away at those yields. An off-plan, by contrast, yields 0% until completion and could face 1 or 2 years of delays. Additionally, financing is simpler for ready homes. Banks in the UAE typically lend only upon completion, so off-plan buyers either pay cash installments or developer mortgage scheme at handover. Some secondary buyers also enjoy mature community infrastructure like schools, malls, public transportation, hospitals, whereas off-plan areas are new and may take time to develop fully around the project. That said, the secondary market has been tight in prime locations. Many owners are holding on to assets expecting further prices up, and new supply of ready homes in top areas is limited, which in turn pushes more buyers to off-plan. In 2024, secondary sales still made up a significant chunk, about 37 to 40% of transactions, and values have risen amid the high demand. By early 2025, Dubai's average property prices were 16% year-on-year, with sought-after villas, communities, and prime apartments leading the appreciation. In some luxury segments like Palm Jumeirah, Emirates Hills, etc., prices are all-time high. So, the secondary market is robust. Both segments are thriving, but off-plan is currently the star of the show volume-wise. What about distressed properties? These are deals where a seller is under pressure to sell quickly, potentially below market value. For instance, an owner facing loan default, a need for urgent cash, or an off-plan flipper unable to continue payments to the developer and willing to exit cheap. In a rising market like today's, through distressed, sales are fewer. However, opportunities still exist, and specialized brokers advertise distressed deals at 10 to 30% below market prices. These might be units from earlier phases now completing, where the first buyer just wants out, or even bank foreclosed properties. For investors, a genuine distressed deal can yield instant equity. Example, buying a property for 20% under the going rate. However, one must exercise caution, verify the title, ensure no undisclosed liabilities, outstanding service charges, developer payment, NOC payment, or etc., and confirm that the discount is real by checking recent sales of similar units. It is also key to understand why the seller is distressed. Is it just their personal situation, or is there a problem with the property or project or location? Sometimes an off-plan seller offering a big discount could indicate issues with the development or location. Historically, the best time for distressed buys was during market crash. After the 2008 financial crisis, Dubai's property values plunged by over 50% from their peak. Many high-leveraged owners and speculative investors defaulted, and those with liquidity came in to buy villas on Palm or downtown apartments at half their 2008 prices. Similarly, distress surfaced in 2015 to 2020 slump, when oversupply and weak sentiment pushed prices down roughly 30%, and certain off-plan buyers walked away from deposits. Those periods created fire scale scenarios. In the current climate, 2023 to 2025, by contrast, the market is strong. Distressed sales are more anecdotal and case by case. As an off-plan consultant, I generally don't recommend chasing distressed deals unless you have done thorough homework. Dubai's property landscape is shaped by a few major developers, each with their flagship projects and reputations. Let's examine four of the biggest: Emaar, Nakheel, Meraas, and Aldar, and highlight their success and stumbles based on data. The most prominent developer in the UAE, Emaar, is behind downtown Burj Khalifa, Dubai Mall, Dubai Marina, Arabian Ranches 1, 2, 3, Dubai Hills Stand, and many more. In 2024, Emaar maintained its dominance, roughly around 17,000 off-plan sales. Investors often trust Emaar for its track record of delivery and the strong branding that can boost resale values. For instance, off-plan Emaar projects in prime areas like downtown or Dubai Hills have given solid returns in the recent boom. Many early buyers saw significant appreciation by completion. However, Emaar is not without downsides. During the last oversupply phase, Emaar launched a flurry of suburban projects from 2016 to 2019 that struggled in the soft market. Example, prices for some Emaar townhouses in communities like Reem, Mira Oasis fell by 8 to 9% in 2018 alone. Buyers who purchased at launch in those years had to wait through a dip before values recovered post-2020. Overall, Emaar's strength is in creating entire master-planned communities with amenities that attract end users and investors. But investors should still evaluate each project on its merits, and Emaar logo isn't a guarantee of instant profit. Let's talk about Nakheel, a government-backed developer known for iconic mega projects. Nakheel literally changed Dubai's map with the Palm Jumeirah, the man-made palm-shaped island that is now one of the most prestigious addresses. Original signature villas on the Palm, once sold for roughly around 5 million 2 decades ago, now fetch well over 20 to 30 million in some cases. Nakheel also created the World Island, an ambitious archipelago of 300 mini islands. Nakheel's journey has been bold but bumpy. During the 2008 crisis, Nakheel was at the epicenter of Dubai's debt crunch. It had overextended on giant projects and had to be rescued as part of Dubai World's 26 $6 billion restructuring. Many projects were halted or cancelled. Famously, the planned 1 kilometer tall Nakheel Tower and the World Islands project stalled. In fact, after sinking an estimated $15 billion into the world by 2008, only one island had been developed at first. The rest sat mostly empty for years. Fast forward today, Nakheel has regained momentum under new ownership, now part of Dubai Holding. They revived Palm Jebel Ali, a second Palm Island project frozen since 2009, with new villa launches in late 2023 that sold out rapidly, starting from 20 million. Signaling market confidence in large-scale luxury projects again. Meraas, now under Dubai's holding company structure, is known for trend-setting lifestyle projects rather than entire cities. Meraas often builds mid-scale but very stylish communities and attractions. Think City Walk, urban district with open-air retail and upscale residences. Blue Waters Island, home of and Dubai Vale and luxury apartments. Lamer, beachfront dining and entertainment with new residential developments, as well as high-end enclaves like Bulgari Resort and residences on Jumeirah Bay Island. Meraas projects focus on design, walkability, and integrating leisure with living, targeting both wealthy residents and tourists. This strategy has paid off. City Walk, for example, initially saw a slow start during 2017 to 2019 slow market, but has recently soared in value. In the first half of 2024, City Walk apartment resale prices jumped 14% from a median roughly around 1850 dirham per square feet in 2023 to about 2150 square feet, spurred by Meraas launching new phases, Central Park and World, at even higher prices over 3000 dirham per square feet. In other words, Meraas' new luxury offerings lifted the value of existing stock, a boon for earlier investors. Similarly, on Blue Waters Island, property values climbed as the destination became fully operational. On the flip side, Meraas has shown a tendency to pivot and redevelop, which is not necessarily bad, but investors should be aware of the evolving plans. For instance, the popular Lamer beachfront was shut down for redevelopment in 2023 as Meraas with partners reimagines it into Javan Beach, a new ultra-luxury beach club zone. While this will likely enhance value long-term, it meant a period of construction and changes. Meraas' strength lies in creating lifestyle appeal, but investors should gauge the market niche. Meraas properties are usually premium priced, so their performance ties to luxury demand. In the current climate of record luxury sales, Dubai saw a 20% rise in $10 million plus home sales in 2024. Meraas is riding high. Just be mindful of the pricing and liquidity. These are typically high-end, high-cost investments. Let's talk about one more prominent developer, Aldar Properties, Abu Dhabi's largest developer, though increasingly active across the UAE. Aldar is behind major developments in the capital like Yas Island, home to Ferrari World, Yas Mall, and multiple villa communities, Al Raha Beach, and many residential projects housing Abu Dhabi's growing population. Aldar has a reputation somewhat akin to Emaar's in the Abu Dhabi, master developer with semi-government backing, known for delivering large projects. The market dynamics in Abu Dhabi, however, differ from Dubai. Abu Dhabi's real estate has historically been more conservative. Prices and volumes were slowly compared to Dubai's volatility. For example, in 2024, key Abu Dhabi communities saw price increases of 5 to 10%, a healthy growth, but far below Dubai's roughly around 16% average jump the same year. Rental yields and ROIs in Abu Dhabi are solid, 5 to 6%, but generally a tad lower than Dubai's market. For Aldar investors, this means you might get a steadier, if less speculator return. Aldar's projects tend to cater to end-user demand in Abu Dhabi, which has a large local and long-term expat community. One notable point, Aldar itself went through consolidation after the 2008 crash. It merged with competitor Suruh in 2013, a government-backed move to stabilize the property sector then. The merged Aldar was on firmer footing, and since then, Abu Dhabi's supply has been tightly controlled. Hence, no extreme oversupply there in 2010. Now Aldar is expanding beyond Abu Dhabi. It has launched projects in Dubai, example, a commercial tower on Sheikh Zayed Road and joint venture in Dubai suburbs, and even in other Emirates. Investing with Aldar typically offer confidence of government support and quality, but one should temper expectations. You may not get the rapid capital spikes seen in flashy Dubai launches, but you also may face less risk of wild market swings. In short, Aldar projects are often slow and steady, an attractive proposition for more conservative investors and those interested in Abu Dhabi's market, which is currently also on an upswing. Property transactions volumes in Abu Dhabi hit record high in 2024 as well. As we have come down to the last part of this video and very important for you, Dubai's real estate is often characterized by high rewards but also high risk. The current cycle 2021 to 2025 has seen tremendous gains, especially for those who bought around 2020 to 2021. Off-plan properties have surged in popularity, riding a wave of optimistic sentiment, population growth and government initiatives. Secondary market properties are also benefiting, with prices and rents climbing on strong fundamental demand. And while distressed deals are few in a boom, the very strength of the market tells us that investors are confident in Dubai's future. Perhaps rightly so, given the city's ambitious vision, Expo 2020 Legacy 2033 and 2040 Master Plan, etc. However, it pays to remember real estate is cyclical. Bold and assertive truth, markets can and do turn. If the developers overshoot and hundreds of new projects are launched without equivalent buyer growth, oversupply could return and pressure prices. Global economic factors, interest rates, oil prices, geopolitical events can dampen demand, which in a speculative off-plan environment might lead to a sudden drop in off-plan buyers, and those holding overpriced contracts could be stuck. As of now, experts note that demand is outpacing supply in Dubai's market and new units are being absorbed well. The city's push to attract affluent residents through golden visa, relaxed laws, etc. provides a cushion. But prudent investors will plan for multiple scenarios, focus on quality assets, not just hype, negotiate hard on prices, whether it's off-plan or secondary, and maintain liquidity or financing buffer to weather or any market pauses. In summary, off-plan versus secondary versus distressed is not a one-size-fits-all choice. Each has its role. Off-plan is great for capital appreciation potential and often a smaller upfront outlay. Secondary is ideal for immediate utility and income, and distressed can be an opportunity if you are shrewd. As an off-plan consultant, I naturally gravitate to the excitement of new projects, but I always advise my clients with transparency. If a secondary resale or a rare distressed deal is genuinely better for their goals, that's what they should do. The ultimate goal is a sound investment, not just a sale.